Hello and good morning, listeners. Welcome back to Almus Market Mornings, a consistent space for global financial updates with Jayaram Krishnamurthy. Now, folks, few developments are worthy to track, and amongst that is the contraction in the Germany's manufacturing sector, keeping in check the euro strength in place along with the rest of the factors. Now, likewise, another worthy ones are the domestic GDP data, which is lower than expected, and the increase in the FX reserve numbers, which are now at a new high of USD 681.69 billion. Now, JK, these are few of the developments, but what are your take on such developments across financial markets?
Yeah, good morning, Shikhar. We had been a long wait for getting more clues on the US economic picture last week because the initial part of the week was very quiet. Dollar bears were hoping for some more clues of Fed cutting more than just 0.25 in September, but that was not to be because on Thursday we got a GDP number which was double of original estimate, more than double in fact. That also showed consumption holding up and adding to the GDP number. And then we had the PCE inflation number on Friday. That was again a disappointment for dollar bears because the price increases were, rather the price situation was not too different from what the market had been expecting. Year on year, it actually fell by 0.1%, but on month, it actually rose 0.1%. Nothing drastic as a change for market to change the expectation of 0.25% rate cut. So now market has to wait for the non-farm payroll on Friday, which will be probably the final say on how the Fed goes. If we do get a number like 4.5% unemployment rate, yes, it increases the chances. We have 3 or 4 cuts this year. Otherwise, if it stays at 4.3 or even slips by 0.1% to 4.2, then we will once again see the dollar bulls rising and then floating the strong economy theory, no recession, etc. These narratives will come into play once again. So, also the dollar bears did not get much hope because of Eurozone inflation also dipping to 2.2% on a year-on-year basis. That is the lowest since July 2021. So Euro continues to slip, but at a snail's pace. But we are quite away from the high of 1.12 and we are at 1.1040. Possibly we will test below 1.10 as well in the coming days ahead of the key data. So I think stock markets were cheering it because they had seen less evidence of a recessionary trend in the US. All the major indices in the US gained on Friday, building on their recent recoveries. Now most of the indices are near their all-time highs once again. Of course, the exception being India, which has beaten the all-time high by a good mile. Yields were again higher, quite high from the lows that we have seen for both 2-year and 10-year. Interestingly, the yield curve itself has actually flattened, and we have been talking about inverted yield curve for quite some time. Now we have 2-year yield at 2.92 close to, and 10-year at 3.92 and 3.90, hardly any difference. So that's another possible recession watchers to give up their theory possibly. But then we need to watch the unemployment data this week, which will give a better indication of the economy, definitely. Yes, on the Indian side, yes, we had a very good inflow in the last few days. 3 to 5 billion was being mentioned, but definitely the FPI data shows that inflows for the whole week had risen by more than 3 billion, and much of it had come from equities. This is it is also said that there was a huge rebalancing in favor of India that led to this large inflows, and Of course, the impact on rupee was limited, as you would expect, because the central bank was there absorbing the flows at the 83.85 levels and not letting rupee to strengthen. Yes, as you also mentioned, the GDP number from India was somewhat disappointing. Came at 6.8% versus 6.7% versus 7.8% that was seen in the last quarter, and 1 year ago it was above 8%. But again, this is not much of a concern, because RBI has projected a full year growth at 7.2%. That can well be achieved with the growth drivers like government spending picking up pace later in the year. Agricultural activity will pick up with good monsoon. Private corporate investment is already gaining some steam, as the capacity utilization has reached highest level in the last 9 years. So nothing to worry as far as GDP number from India is concerned. Yes, headline was slightly disappointing. But I think India will maintain its superior growth rate, as far as the GDP is concerned among the major economies. And none of this actually changes the rupee's trajectory, which continues to be, if you can call it as a trajectory, because it's really a band within that all the bullishness and bearishness is packed in. So we are in 83.75-84 range. We'll continue within that unless we see a break of dollar index below 100 as an effect of the week's data, or if there is a stronger rebound in the dollar. I think rupee will continue to be in this range. Thank you.
Okay, JK, that was quite good. And yes, folks, USDINR continues to be in a very narrow range. But as JK mentioned, although the GDP numbers were on the face a bit concerning, but the good monsoon, high capacity utilization, consumption, and the numerous other factors can keep the economy afloat towards the target of 7.2%, as mentioned earlier. And it is also being observed by the kind of flows coming in the equity markets by the FIIs. On the international front, folks, the major thing is to watch out for the yield curve. As JK mentioned, it has flattened, something which the recession expecting set of community was keenly watching on. Other than that, the Eurozone inflation dipping and the core PC being a disappointment for the dollar bears continues to, have some sort of influence on the market. But overall, there's not been much to shake up the market. So we'll continue to wait for further updates for the likes of NFP numbers in this week to get the sense of what sort of actions the Fed will come up with. That's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for listening.